What's up, YouTube? It's Brandon Cuellar. If you were curious about how to qualify for a mortgage if you're self-employed, keep watching. All right, so how do we qualify for a mortgage when we're self-employed? There's a couple ways we can do it. The easiest way and the lowest interest way, lowest down payment way is a full doc loan. So let's explore that. A full doc loan is when we take your past 2 years of tax returns, we average those 24 months of income, we take into account all your deductions, all your expenses, everything like that, and we use that income to qualify you. Great. So why wouldn't we do that? The only reason why we wouldn't do that is if you have too many deductions on your taxes, which a lot of people do that run small businesses, to show enough income to actually qualify for the type of house that you're looking for. So let's look at other options. One of my favorite options is going to be a bank statement loan. Bank statement loans are as little as 10% down. You could buy anything from 1 to 4 units. You can use this to buy a home or do a refinance or a cash out refinance. And this is how a bank statement loan works. We will look at the past 12 months of either your personal or business bank statements. We'll average your deposits for those 12 months, and based on your industry, we'll take an expense ratio off of those deposits. A standard expense ratio may be 50%, but could go as low as 10%. So it makes a huge difference what industry you're in. For example, I'm working with a nanny right now. Obviously, being a nanny doesn't have many expenses. You're going to pay for gas, getting to and there, and that's pretty much it. So for her, we're able to use a 10% expense ratio and pretty much use all of her deposits in her bank statement to go ahead and help her. Another great option is a profit and loss statement loan. So let's talk about that. All we need for this type of loan is a profit and loss statement filled out and signed by your CPA to show your income for the past 2 years. Now, this never goes to the IRS, so this is only for loan origination use, and it does not need to match your tax returns. Also, we don't typically look at your tax returns on this type of loan, same with the bank statement loan. So it's up to your CPA to give us accurate information, of course. I always say go to your CPA, book an appointment, bring your bank statements, bring anything they may ask you to bring to give an accurate understanding of what your income actually is. So again, once they fill that out, we'll use the income on those statements to go ahead and finish with your qualifying income. Another option is going to be a 1099 income loan. So let's say you work for Uber, DoorDash, or really just any 1099 income. We can take the past 2 years of 1099s, so just the form you get in the mail, and we can use that in a standard expense ratio depending on your industry, and we could use that to qualify you. So that's another great option as well, another 10% down option. The last option that some self-employed buyers opt to use is a asset depletion loan. So this is a loan where you don't actually need to provide any sort of income documentation. We're more so concerned about your assets. So do you have enough money in the bank, and there's a certain calculation we use to be able to divide that by a certain number and see if you qualify. So if you're someone who can't prove their income or have documentation for their income in an easy way, a great example of this is someone who earns their income outside of the United States. And there's all kinds of different unique niche scenarios. But let's say they have, $3 million in the bank and they want to buy a $400,000 house. We can probably help them. Now, those loans typically have higher down payment requirements, something along the lines of 20 to 30%, but it's definitely an option. Now, the last option, but really a great option, is a 1-year self-employed loan. Now, let's talk about that. I just helped a lady who does eyebrows, and she worked for Ulta for about 5 years. Now, she wanted to do it herself. She figured she wanted to work her own hours. She wanted to do it a better way, and she wanted to build a business for herself and her family. So we're able to just use 1 year of tax returns because she only started that 1 year ago. We're able to use 1 year tax returns as long as you were working in the same industry prior to that. So same thing if let's say you have a landscaping business, and before that you worked at a big landscaping company as a W-2 employee. We just show documentation that you did work there. We're not using that for income purposes. The only income calculation we're using is your 1 year tax return. Now, obviously we need to make enough on this tax return to qualify, but as long as you do, then this could be a really great option. Now that option is a full doc option, so that's a 5% down option, or actually for this lady that we just helped, she actually put 3.5% down on an FHA loan. So plenty of great options if you're self-employed. This is really just scraping the surface. If you have specific questions on if you might qualify or how to qualify, different ways to plan in advance, don't hesitate to either reach out to me. You can give me a call at 940-222-2215. You can also shoot me an email. I'll put my contact info in the description below. Hope you enjoyed the video. If you got something out of this, hit the like button, comment what you learned, and I'll see you next time.